Okay, so the buzzword out there right now is inflation, housing running out of control, and a banking issue. So that's what we want to address today because if you're watching this video, you're concerned about the markets and you're really concerned, about housing because that's what we focus here on the channel. Because my goal here is to educate and inform you guys everything financial, especially with a focus of real estate because I'm a mortgage advisor. So if you're out there looking for a mortgage, we'd love to help you and all my information is down below. But today what we're going to talk about is the biggest thing in the markets that we're seeing right now is inflation. So what's going on with that and what do we expect from the Fed? That's our concentration today, and I'm going to show you the figures and all the data that Wall Street's providing us. So what you're seeing on your screen right now is what's going on in the bond markets, and I follow this on a daily basis, well, all day long, to figure out what in the world's going on in the bond market because that is really what puts in place the mortgage rates. So what you're seeing on your screen right now, you can't see most of these numbers up here because I have a green screen behind me. So if anything is in green, which is good news, is you can't really see, but I'll provide these numbers for you. Right now, the 10-year Treasury, its yield is down, which is good. So that's why it's in the green, down 1/100th. So it's really not going to make a difference. MBS market right now is up 0.08 and up 0.08. So nothing really there. That's not enough to make any rates change. Okay, so let's go down through here. Some ground after higher jobs claim losing. Okay, so let me put some of this stuff into perspective. Let's look at the economic calendar for today to figure out, what is there any game changers coming to the market today? So yesterday, what we saw on Wednesday was the ADP payroll numbers, and they came in pretty dismal, and you can see those right here. So the number of previous jobs that were created last time based on ADP's numbers was 261,000. They expected 200,000. It came in at 145. Dismal number. These numbers are terrible. This basically says the manufacturing or non-manufacturing sector productions is plummeting. So that means that's more validation of a recession. But I'm going to continue on this, guys, because I don't have much good news on the recession front, but I do have good news on what's going on with rates. Okay, so then the next thing we have Thursday, we have so far is initial jobless claims. How many people are losing their jobs? Well, the last reading was 246, and we expected this number to continue to rise. So the number came in where the analysts thought it was coming in 200. It came in at 228. So not as high as where we were previously, but it's still a pretty big number there. And then the markets are closed tomorrow. So let's go over to headline news, see what we have there. Right here, this validates a lot of the stuff we're talking about. Layoffs are up nearly fivefold so far this year, with tech leading the way. So tech has lost hundreds, if not hundreds of thousands of jobs. So that's basically what we got in the headlines right now on this. We're not going to look at anything else. The banking chaos. Guys, just go through that smoke screen because people are just trying to get your views here. There's really not much there. So let's get over to Yahoo, see what Yahoo has to tell us. And they probably have the same thing, but let's see what the markets are doing so far. We have the S&P, Dow, NASDAQ, all down, signaling a down open. Then we have the Russell 2000 start signaling an up, a little bit of an up for the day. What do we have here? Stock futures fall ahead of key jobs reports. Let's kind of dig into that. You can see nothing but really jobs, recession, and so forth. So let me put some of this into perspective. We know that the inflation was running rampant, but a lot of the figures that the Fed uses is dated. And a perfect analogy is right here. Here's I watch CNBC. I do all your research for you guys. So what you see on your screen right now is this. What's happening with rents or housing costs when it's a part of our inflation numbers, which is the CPI. Rents and housing equate out to a third of our inflation numbers on the CPI. Okay, so if the Federal Reserve, I did a study on this yesterday, if the Federal Reserve actually monitored real live data, which they can easily find through Realtor.com and Zillow and things like that, they can find this data, but their systems are so archaic. But here's a perfect analogy. Actual rents are on this screen, and they're shown right here in the blue line. So you can see back in June, mid last year, we peaked. From there, it dropped, and continues to drop. So this is what's happening to actual rents based on all the companies that hold that data. And it's not fictitious data, guys. It's real solid data. Well, here's the line of the CPI based on what the Federal Reserve uses. You can see how lag it is. So this could probably be moved over to here, lag up to here. You understand what I'm saying? If this chart was live, it'd be over here. This number here, the high would be right here. here and we'd be starting to drop down. Now, based on this analysis, when you run the numbers, this would, if the Fed just did this, adjusted the housing expenses in the CPI, it would drive the inflation number all the way down to 2.6%. Remember, the Federal Reserve's gauge is 2. So we're almost there. And then you start seeing energy and a lot of food and parts of food, eating out. Chicken, eggs are plummeting, folks. The gas prices and oil prices, that's why they exclude those from the core CPI. They exclude energy from that because it's way too volatile. But this is very interesting. If you look at this, it's basically telling us, okay, we're pretty much where we almost need to be. So based on that, where is the federal funds rate? So let's focus in on the Fed right now. So the Federal Reserve, what they control is what's called the federal funds rate. That's it. They don't control mortgage rates, car loans, anything like that. They just affect the federal funds rate. Well, here's where we are right now. So you can see the federal funds rate right now is 4.83. The target range is 4.75 to 5. See, right over my head. And I'm sorry, we just got done exercising and walking, and I figured I'd do my video. So you can see that's the target rate. Okay, remember that 4.75 to 5. Okay, so let's jump over to the Chicago Mercantile Exchange, the bond, the futures market, to see where all the money is going in regards to this, to see, how much more is in what the Federal Reserve needs to do in increasing rates. Well, again, remember the federal funds target right now, 4.75 to 5. You scroll over here. Here's the futures market. Okay, so let me get my head out of the way. And here it is. So the futures market right now in the Chicago Mercantile Exchange, I'll show you where I'm getting my data, so I'm not making it up. Okay, there it is. Right there, CME Group. And you scroll down and you see right here, the federal funds rate in May, here's what they expect. The May meeting, the federal funds rate has a 55.6% probability of being at 4.75 to 5. If you go back to here, where are we? Target rate of 4.75 to 5. So we're there. Okay, so we're there. So technically what this is telling us is the Federal Reserve has no more rate increases in place. Actually, what it's signaling us is they're going to stay stable here because it has a 50% probability or more. Basically, you're looking at the blue signals, okay? And then look at the blue signals from here. Continue to go down, 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 all the way back or to the future of next Q4 of 2024. They're expecting the federal funds rate to be 2.25 to 2.5. Look at that, a 3% reduction in the federal funds rate. So that's what's on the horizon, folks. And again, all these blue lines, and this is from the Chicago Mercantile Exchange, where people put in billions of dollars to figure out what's going on in the markets. So there's really not that much economic news today, but I just wanted to give you guys the great input right now. The jobs market is taking a toll. Okay, so when you lump all this together, what does it really tell us? Well, sales are plummeting. The job market's really suffering. The yield curve is inverted, equals, guys, we're getting in a recession, and it's almost foolproof right now that we will be in a recession. The average recession in the last 5 recessions, mortgage rates dropped on average of 1.8%. So where are we today? So maybe if you're focusing in on this and you're like, well, maybe should I wait? And if that's what you're looking to do, God bless you. Let's get over and figure out where mortgage rates are right now. So we look there as we look at the MBS market, just like we looked at over here, but in a basically easier format for you guys to read. So if you want any of these charts, if you're a mortgage advisor and you want to use MBS Live, there's a link down below for you to subscribe to that channel. But what I'd suggest you do is subscribe to my newsletter down there, because you're going to get this plus commentary plus much, much, much more. And it's free. I don't sell the data. So let's get over to where mortgage rates are. Here's where the rates ended yesterday. Actually, no, this is already live today. My apologies. This is already updated. Right through here are the top 6 products people use when they're buying or refinancing a home. This is rates published by Mortgage News Daily on a daily basis. And if you want this, you want to get this emailed to you each day, you can link down below to this as well, Mortgage News Daily. But again, if you subscribe to mine, you're going to get more than enough data to make up your minds. But you can see right here, mortgage rates on the 30-year fixed rate now today are down almost 0.25%. So a nice little reprieve from where we've been, and especially look at the 52-week high and low. The 52-week low was 5%, basically. The 52-week high was 7.375. So we're down about a 1.25% from where we were back at the beginning of the year. And that's not too long off. So if you actually close your loan in, say, November, December, January, you might want to reach out to us because it might be a good time for you to look at the numbers to refinance. Yes, you can already refinance, believe it or not, and take advantage of these, I can't say the lowest rates or real low rates, but lower than where they were. So folks, this is my report for today. So the goal here is, like I said, to educate and inform you guys everything financials, but we focus in on real estate. And what this is telling us is a recession is inevitable. The inflation numbers are coming down and coming down faster than we actually expected. And if you look at this, the housing number in all this data, it's really signaling that the Federal Reserve is behind the curve, and they need to really stop doing what they're doing. And it's probably likely that in the next couple meetings, they're going to pivot and start reducing rates. And that's good for the economy, but that's not really good for basically everything in general, because a recession is on the way, folks. And I hate to be the bearer of bad news, but you're going to hear this more and more and more on a daily basis until they say, yep, folks, we are in a recession. So hang tight. Everything will be okay. Happy Easter to all those out there. God bless you. Please, all I ask you to do is hug a loved one. Tell them you love them. Go visit a family member that you haven't visited in a long time, because it's a holiday season. It's Easter. It's the resurrection. And that's our purpose in life. So God bless, guys. Thank you so much for watching. If you would, please don't forget to give me a thumbs up. Subscribe down below. And if you like my videos, please hit the bell so every time I do post, you get an alert. Take care, guys. God bless. And I'll see you next week. Bye-bye.